Picture this. A young couple sits down across from a life insurance agent. 2 kids. A mortgage. A busy life that already feels like it's running at full speed. They've got one question, and it's the same question almost everyone asks first. How much coverage do we actually need? The agent doesn't hesitate. He glances at the income number, does quick mental math, and says, a good rule is 10 times your income. For you, that's about $1.3 million. The couple nods, grateful it sounds simple. They leave. 3 days later, same couple, different office, different agent. Same kids. Same mortgage. Same income. Same question. This second agent doesn't lead with a number. She starts asking things. How much do you still owe on the house? What other debt do you have? How old are your kids? Do you want to help with college? How much savings do you already have? And then she writes for a while. She taps the paper. Looks up. Okay. I'd recommend $2.6 million on him, and about $400,000 on her. Same family. 2 professionals. A gap well over $1 million. So who's right? Here's the uncomfortable truth. In a way, both are right. They're using different methods. Both methods are taught. Both methods are used. And the method someone chooses often determines the number you end up buying. Today, we're stripping the mystery out of this. You're going to learn 4 different ways to calculate life insurance needs, starting with the quick and dirty method, and working toward the approach all planners consider the professional standard. And we're not doing this in the abstract. We're going to follow one family the entire way, so you can track how the same situation produces wildly different answers depending on the math. Because the right amount of life insurance isn't a vibe. It's not a slogan. It's not a multiplier. It's the amount that does the job your family would need it to do, on the hardest day of their life. Welcome to Wiseside Life and Legacy. I'm your host, Na-kel Nikiema, and this is episode 3, How much coverage do you actually need? The real math. If you're new here, the promise of this show is simple. We talk about life insurance without turning it into a sales pitch. This is education you can take into your own decisions, whether you buy a policy this month, this year, or never. Over the next 45 minutes, here's the path we're walking. First, you'll meet the Carters, our fictional example family. Then we'll go method by method. Method 1 is the income multiplier. It's fast. It's popular. It's also usually the least helpful, because it ignores most of real life. Method 2 is dime, debt, income, mortgage, education. This is the first approach most people can actually do themselves at the kitchen table. Method 3 is human life value, the economist's approach. Cleaner math, different assumptions. Method 4 is capital needs analysis. This is the deep, professional process, needs, timelines, existing resources, and the actual gap insurance needs to fill. After that, we'll talk about when each method makes sense, because the best method depends on where you are in life. And then you'll get a simple assignment, a 30-minute worksheet you can run this week to get a real number for your household. If you can, grab a notebook. You don't need fancy software. You just need a spot to write down a few figures. Let's meet our family. David and Maya Carter. David is 38. He's an electrical engineer at a mid-sized tech company, earning $95,000 a year. Maya is 36. She's a graphic designer, working part-time so she can be home with the kids. She earns $35,000 a year. Together, their household income is $130,000. They have 2 children, Olivia, who's 7, and Mason, who's 4. Now the balance sheet. They have a mortgage balance of $320,000, with 24 years left. They still owe $18,000 on Maya's car. They have $12,000 in credit card debt they're paying down. And they've got $40,000 in savings, some emergency money, some retirement. This is not an unusual family. That's why they matter. They're close enough to real life that the math feels real. As we go through each method, keep one thing in mind. The family never changes. Only the method changes. And the method you use can swing the answer by over $1 million. That's the real lesson of this episode. Method 1, the income multiplier. You've heard it before, even if nobody called it that. It's the 10 times income rule. Some people say 7 times. Some say 12. But the idea is the same. You take your annual income, multiply by a number, and that's what you're told you need. It's a shortcut. And shortcuts are tempting, especially when the topic is uncomfortable. Let's run it for David. David earns $95,000 a year. Multiply by 10. That gives you $950,000 of coverage. Most people round it and say, call it $1 million. Now Maya. Maya earns $35,000. Times 10. That's $350,000. So under the income multiplier approach, the Carters might hear they need roughly $1.3 million combined. Here's why people like this method. It takes under a minute. It doesn't require you to open a spreadsheet. It doesn't require vulnerable questions about debt or goals. And in a narrow set of cases, say you're young, single, no kids, no mortgage, and you just want a basic cushion, it can land in the general neighborhood. But for families with real obligations, it starts breaking down immediately. First, it doesn't look at debt. The Carters have a $320,000 mortgage. The 10 times income method doesn't care. It doesn't even ask. Second, it doesn't look at time. A 38-year-old with a 4-year-old needs income replacement for a very different stretch of years than a 58-year-old with grown kids. The multiplier ignores that. Third, it ignores assets. A family with $40,000 in savings is not the same as a family with $400,000. The multiplier treats them like identical households. Fourth, it ignores future obligations, like college. It ignores childcare costs. It ignores the financial shock of needing extra help around the house. And fifth, and this is the sneaky one, it ignores the survivor's reality. If David dies, does Maya really go back to full-time work immediately? Can she? Does the child schedule allow it? Does grief allow it? The method never asks. So here's how I want you to treat the income multiplier. It's a rough sanity check. It is not a plan. If someone can give you your coverage number without asking you anything about your life, they're not doing a careful analysis. They're doing the easy version of a hard job. Now let's step up into a method that most people can actually use to get a meaningful number. Method 2, dime. Gimme. Debt. Income. Mortgage. Education. This is the first method in today's episode where I want you to consider pausing and running it for yourself later. It's not perfect, but it's practical, and it forces the right categories into the conversation. The idea is simple. You total up debt. You estimate income replacement. You add the mortgage balance. And you add a target for education. Then you add those 4 numbers together. Let's walk through it with David Carter. D is for debt. This is non-mortgage debt. Think credit cards, car loans, student loans, personal loans. The point is that if someone dies, the family shouldn't be juggling minimum payments while trying to keep life together. For the Carters, $18,000 on the car. $12,000 on credit cards. That's $30,000 of non-mortgage debt. Now I is for income. Instead of 10 times, dime asks a better question: how many years does the family actually need that income? A common planning approach is to cover until the youngest child reaches about 22, roughly the point where they're expected to be independent. Mason is 4. 22 minus 4 gives us 18 years. So we take David's income, $95,000 per year, and multiply by 18. 95,000 times 18 is $1,710,000. $1.71 million, just for income replacement. Notice what just happened. Under the income multiplier, David was at $950,000. With Dime, just the income line alone is already far beyond that. Next, M is for mortgage. Dime typically uses the full outstanding mortgage balance, because one of the most protective financial moves you can give a surviving spouse is eliminating the housing payment. The Carters owe $320,000. So we add $320,000. Now E is for education. This is where values come in. Some families want to pay for 4 years at an in-state public university. Some want to cover private school. Some want to cover trade school. Some want to cover nothing. And focus on stability. We need an estimate. A reasonable planning estimate for 4 years at an in-state public school, including living costs, is about $120,000 per child in today's dollars. The Carters have 2 kids. So $120,000 for Olivia. $120,000 for Mason. That's $240,000. Now we add it all up for David's Dime number. Debt, $30,000. Income, $1,710,000. Mortgage, $320,000. Education, $240,000. Total, $2,300,000. $2.3 million. Let's pause and let that land. Same David. Same family. But the number jumped from $950,000 to $2.3 million, simply because we chose a method that actually looked at obligations and timelines. Now, what about Maya? This is where a lot of households accidentally leave a huge hole, because they only insure the bigger paycheck. Maya earns $35,000 a year part-time. If we used the same 18-year horizon, 35,000 times 18 equals $630,000. But income is only part of her contribution. Maya is also doing work that isn't on a W-2, childcare, logistics, household management, the invisible labor that keeps everything running. If Maya dies, David likely has to pay for services Maya was providing with her time. A conservative way to estimate that replacement cost is $30,000 to $40,000 a year for a family with young children. Let's choose $35,000 a year as a middle estimate. And let's assume that cost is most intense until the kids are older, say 14 years, taking Mason from age 4 to about 18. 35,000 times 14 equals $490,000. So Maya's coverage need, just combining her income over 18 years and unpaid labor replacement over 14 years, is about $1,120,000. That's a little over $1 million. Compare that to the income multiplier's suggestion of $350,000. This is why part-time and stay-at-home parents are so often underinsured. We accidentally price them at income only, and ignore the cost of replacing the work they were doing every day. Dime isn't perfect. But it's powerful because it forces you to name the big buckets: what you owe, what you need to live, how you'll keep the roof, and how you'll launch the kids. If you only do one thing after this episode, Dime is a great start. Now let's move to method 3, which comes from economics rather than practical household budgeting. Method 3, human life value. This approach sounds a little clinical, but the underlying question is a fair one: what is a person's future earning power worth today? If your income is like a stream of payments your family depends on, then there's a present value to that stream, just like there's a present value to an annuity or a pension. Human life value typically asks 4 things. What's your current income? How many earning years are left until retirement? What portion of your income is actually supporting your household, versus your own personal expenses? And what discount rate do we use to translate future dollars into today's dollars? That last piece matters because a dollar received 20 years from now is not the same as a dollar received now. Money today can be invested. Let's run the numbers for David. Income, $95,000. David is 38 and plans to retire at 65. That's 27 years of work remaining. Next, we estimate the share that benefits the family. A common split used in examples is 70% family support, 30% personal consumption. 70% of 95,000 is 66,500. So the family supporting income stream, in this simplified view, is $66,500 a year for 27 years. Now we discount to present value. If we use a 4% discount rate, the present value of that income stream comes out to roughly $1.15 million. So human life value says David's economic value to his family, today, is around $1,150,000. Now notice the contrast. Dime gave us $2.3 million. Human life value gives us $1.15 million. That's not a small difference. Why does this happen? Because human life value assumes a single lump sum representing the economic value of future income, without separately adding mortgage payoff, debt payoff, and college funding. In other words, it assumes the income stream would have covered those things over time anyway. And it's also extremely sensitive to assumptions. Change the discount rate and the number moves. Change the family share percentage and the number moves. Change retirement age and the number moves. The strength of human life value is that it's mathematically clean. It gives you a defensible number for earnings capacity. It can be especially useful for high earners or complex income situations where you need a formulaic justification. The weakness is that families don't experience loss as a clean economics problem. There are immediate bills. There are one-time obligations. There are goals that aren't income replacement. Human life value is elegant. But elegant math doesn't automatically equal a fully protected household. So now we go to method 4, the one designed to match the way families actually experience the financial shock of loss. Method 4, capital needs analysis. This is the gold standard when it's done correctly. It's also the most work. Instead of pretending every household can be solved with one formula, capital needs analysis does something more grounded. It asks, if the person dies today, what immediate cash needs show up right away? And then, going forward, what income does the household need, and for how long? After that, and this is the critical part, it subtracts the resources the family already has. Savings. Existing insurance. And, often overlooked, survivor benefits. The result is not total need. It's the coverage gap. Let's do this for David Carter. Step 1, immediate cash needs. These are the lump sum expenses that don't politely wait for the family to get organized. Final expenses. Funeral and related costs. Let's estimate $15,000. Mortgage payoff, $320,000. Other debt payoff, $30,000. An emergency fund boost. The Carters already have $40,000 in savings, but a planner might want the survivor to have a full year of expenses set aside with confidence. Let's add another $40,000 as a cushion. And education funding, $240,000, to cover both kids' college target. Now add those immediate needs. $15,000 plus $320,000 plus $30,000 plus $40,000 plus $240,000. That totals $645,000. So the moment David dies, the household has about $645,000 in immediate capital needs under this plan. Step 2, ongoing income needs. We ask, what does it take each year for Maya and the kids to live? Before death, households often use something like 85% of gross income for living expenses after taxes and savings behavior. 85% of $130,000 is about $110,000. After David's death, expenses likely drop some, fewer personal expenses, maybe less discretionary spending, but they also might rise in other ways, like needing paid help. Let's assume the ongoing annual need is about $88,000. Maya earns $35,000 right now. So the income gap is $53,000 per year. For how long? We'll use the same horizon as before, until Mason reaches 22. That's 18 years. Now we calculate the present value of that income gap. Using a 3% discount rate, the present value of $53,000 a year for 18 years is roughly $730,000. So now we have two big numbers. Immediate needs, $645,000. Present value of the income gap, $730,000. Total need, $1,375,000. Step 3, subtract existing resources. This is where capital needs analysis often separates itself from the other methods. First, employer-provided life insurance. Many employers include basic coverage, often around one-time salary. If David has one-time salary through work, that's $95,000. Next, Social Security survivor benefits. These can be meaningful for a surviving spouse with children, depending on the worker's earnings record. A reasonable ballpark estimate here might be about $2,500 a month, around $30,000 per year, until the youngest child turns 16. Mason is 4, so that's 12 years. Discounted to present value at 3%, that might be around $300,000. Now add existing resources. $95,000 plus $300,000 equals $395,000. Step 4, calculate the gap. Total need, $1,375,000. Minus existing resources, $395,000. That leaves a coverage gap of $980,000. So under capital needs analysis, David needs about $980,000 of new life insurance, because the rest of the need is already covered by resources we can reasonably expect to exist. Now, let's put all four methods side by side. Income multiplier, $950,000. Dime, $2,300,000. Human life value, $1,150,000. Capital needs analysis, $980,000. Same family. For legitimate methods. A range from about $950,000 to $2.3 million. That spread alone should change how you listen to anyone who throws out a number quickly. And it also reveals something important. Dime, in this case, is giving total needs without subtracting what the family already has access to, like employer coverage and survivor benefits. If you adjusted Dime by subtracting roughly that same $395,000, you'd get around $1.9 million. Still higher than the $980,000 from capital needs analysis, because Dime is built to be conservative and simple. But you can see how the numbers start to come closer once you account for resources. Capital needs analysis is the method that begins with the most honest question: what does this specific family actually need, and what do they already have? That's why professionals lean on it. It's not because it's fancy. It's because it's specific. So what should you actually use? The frustrating answer is, it depends. The helpful answer is, it depends in predictable ways. If you want a quick reality check, and you're not ready to gather a bunch of details, the income multiplier can give you a rough neighborhood. 5 to 10 times income can tell you if you're wildly underinsured. But treat it like a quick temperature reading. Don't treat it like a diagnosis. If you want something you can do yourself this week, use Dime. It's the best blend of doable and meaningful. It forces you to look at the big obligations most families actually have. And it tends to err on the side of having more coverage, which is safer than being short. If you're a high earner, or your income is complex, human life value can be useful. It gives a clean, defensible number that represents economic value. It can help justify larger coverage amounts when you're dealing with underwriting or carrier limits. And if you're working with a professional, especially a fee-only planner or a fiduciary, push for real capital needs analysis. Not a rebranded multiplier. Not a guess. If they aren't asking about timelines, debts, resources, and the survivor's new income reality, they aren't doing the full work. The right method is the one that asks the most questions about your actual life. The wrong method is the one that gives you a number in 30 seconds. Now for your assignment. Give yourself 30 minutes this week. Not 3 hours. Not a weekend retreat. 30 minutes. And run dime. Here's the sequence. Step 1, debt. Write down every non-mortgage debt. Credit cards. Auto loans. Personal loans. Student loans. Add them up. Step 2, income. Take your annual income and multiply it by the number of years until your youngest child reaches age 22. If you don't have kids, use the number of years your partner would need support, or the years until you plan to retire, whichever is longer. Step 3, mortgage. Pull up your most recent statement and write down the current balance. Step 4, education. Decide what you want to fund. If you want a planning shortcut, use $120,000 per child for an in-state public school. If you're thinking out-of-state public, you might estimate around $180,000. If you're thinking private, understand that $300,000 or more is not unusual. Multiply by the number of children. Step 5, add it up. Debt plus income plus mortgage plus education. That's your dime number. Now compare it to what you currently have. And if you have a partner, run it for them too. Especially if they're the one doing more of the unpaid labor in the home. Because the households that get hurt the most are often the ones who insured the paycheck and forgot to insure the person who made the paycheck possible. Here's the line I want to leave you with, the sentence that captures this entire episode. The right amount of coverage is the amount that makes the people you love whole, not just comfortable for a year. There isn't one universal multiplier. There isn't a magic number that fits everyone. There's only the math, applied honestly to your household. So run dime this week. Write down your number. Look at the coverage you actually own. And the gap between those two numbers, that's your next conversation. Next week, we're continuing the series with episode 4, How Insurers Decide. We'll go behind the curtain of underwriting, how rates are set, what the medical exam really means, and the 90-day prep window that can save you serious money over the life of a policy. Until then, do the math. Find your number. And bring it back with you next time. This has been Wiseside Life and Legacy. Educate. Empower. Protect your legacy.